Thanks for having me. Thank you, everybody else, for allowing me to come present. If you're fairly new to Solid Source, you maybe haven't seen me present, but I do present at y'all's annual event quite often and always look to help out with y'all. We also provide the iBuyer reports if you've ever seen those as well. So I'm going to talk about this. I actually presented at the Appraisal Institute's Atlanta chapter's annual meeting. Derek was there as well. So I like, as Derek said, I'm mostly focused on new construction. We do use the existing home market data via FMLS and Georgia MLS for Atlanta's market to help us as well. Typically in Atlanta today, about 75% of all closings are existing homes, 25% will be new construction. So I'm going to start with new construction, go through existing homes, and hopefully, try to convey what's going on in these slides as best as I can. As Derek said, we'll have questions at the end. I'd be happy to go back to the old slide if y'all want to discuss it in more depth as well. So with that said, new construction in existing homes, this data is going to be through September. We just started getting some of this, some finalizing some of the October data right now, but that really won't be finalized until maybe another week or so. But with new construction, we're going to look at a time 12 months ago from today. So we're looking at the end of third quarter 21. And how did the last 12 months compare to the preceding 12 months? So as you know, COVID really hit, spring of 2020, a little bit of a slow start, but towards the end, third quarter of 20, fourth quarter 20, first half of 21, we were just, having all-time highs across the board, new construction, existing home, prices, closings, everything was crazy. As you can see, new construction prices were pretty flat, but closings up 16.2%. You're going to see new construction really isn't quite as volatile as existing homes, and we'll have a lot of graphs to back that up as well. So what are we looking at the end of September? So just a month ago, prices, we've never really seen this before. Prices up 19.4%. Really starting to catch up with the existing home market appreciations that we've seen, but closings are down 10%. So that's pretty typical if you see prices shooting up that much. We'll go into more detail of why closings are down 10%. It's usually pretty worrisome, but a lot of that has to do with the, how much the market heated up the 12 months before then. So looking at it visually, you're going to see a lot of graphs in this presentation. I think it's really the best way to view the slides, in my opinion. So this is just quarterly new home closings, and then the blue line, the blue dots will be the year-over-year change. And so you can see huge spike after COVID, and then we're starting to decline, but we're essentially back on the same track as we were in kind of the 18 and 2019 closings before COVID was ever even a common word, I guess, in today's society. Zooming it out, though, this is just a projection of 22, and you see where we were at 21 last year. This is total new home closings by year for Metro Atlanta. You can see our peak. We're still only building and closing as many homes as we did in the mid-90s in Metro Atlanta. Our peak was 56,000 closings. We did just about 30,000 last year. We're going to do much less than that this year. As I said, kind of more in the 18, 19 range, but we're still less than half of new home closings from 2005. Looking at it as a property type, so you have condo, townhome, and detached. We're going to really focus on the townhomes here in a second. This is total closings year to date through 22, but I want to focus on the market share. This is the new home construction market share by quarter, dating back to 1997. As you see, we were a pretty big condo construction market for a very long time. And then the market crashed, obviously, in 2007, 2008, condo sell-off, and then condos are pretty much non-existent now in terms of new construction. It's very hard to get financing. For whatever reason, it's easier to build an apartment complex than it is a condo. And some people are just afraid to do so because one way to look at condo construction, if I'm going to build 200 condo units, I have to build it all at once. You can't do it in phases as you would a normal neighborhood. Normal neighborhoods, we can maybe go in phase 1, 2, and 3. And so if something, market does take a drastic downturn, there's definitely a little bit more risk with condos, but our market, there's a huge need for affordable condos right now. It's just tough to find somebody to build them and somebody to finance them as well. But I want to focus on, after talking about condos, is this rise in new construction townhomes. As you can see, just about, maybe 8 years ago, the attached market share is about 15%. most of that was townhomes. It still is mostly townhomes, but attached market share is actually up over 25% once again, kind of similar to what we had in the early 2000s. But as I said, it's all townhomes. With that, Q1 of this year was the highest market share we have ever seen for new construction townhomes. So builders are trying to find everywhere they can build these. Typically, if land's getting too expensive, builders are going to try to build as many units as possible, and that's where townhomes come into play. The problem is, if builders could, they would build a lot more of them, but a lot of municipalities will block any sort of high density housing construction. So that's why you're not seeing that number. It's probably going to flatline. I can't really see it going too much higher than that. So just looking at new construction townhomes, this is every community with at least 40 or more closings in this 1 year period. This is exactly 5 years ago. And you see very kind of centrally located in our core market. You see Cobb, Cherokee, North Fulton, Forsyth, and Gwinnett. A couple down here in South DeKalb and South Fulton. I'm going to fast forward to the last 12 months. Oh, I've done this every time, but I'm going to highlight a few areas before we fast forward for the last 12 months. You can see there's pretty much zero activity in all of these. And then looking at today, we have the same 4 circles pop up. Same parameters. This is all subdivisions with 40 or more closings. So I think before we had 15, now we have 56 subdivisions shown. And you can see all those areas. I really want to focus on this in-town kind of I-20 corridor. Definitely a hot spot, with the belt line going in. You've seen a lot more construction centrally located in Atlanta. So this is a 5-mile corridor radius search on I-20 from essentially Douglasville to Conyers. And this was 5 years ago. So it looks like there's actually a lot of activity, but there's only 474 new home closings. Fast forward to 5 years later. So just recently, we now have 1,619 closings all along this I-20 corridor, really centrally located near the Beltline market as well. But you also do have a lot of affordable townhomes going in as well. So you see numbers 1, 2, 3, and 4. That means they're the top 4 selling new home townhome communities in this given time frame. And you can notice the colors are all the same. They're all red. That means they are 282,000 or less. You can see, obviously, once you get closer to kind of that popular midtown market, Beltline market, the prices definitely go up quite a bit. So some more trends. Where is new construction happening? And what are the trends with these counties as well? The top 10 counties: Gwinnett, Fulton, Cherokee. Cherokee is kind of a newer entry. Cobb used to be top 5 perennially, and it's just new construction is so different from the existing homes. And Cobb County will still be probably a top 3 most popular county in Metro Atlanta, but for new construction, it's just hard to find land out there. And if I split up Fulton between North and South, North Fulton would not make this top 10 list. It wouldn't be close. A lot of this activity is on the south side just because North Fulton is so built out. But you're noticing a lot of these counties have had a downward trend. And I'm actually going to flip this. We're going to look at it market share. Percentage change over year. Pickens County, Barrow, Dawson, Fayette, Walton. A lot of these are non-core markets, obviously, and that's where builders are flocking to. They're trying to find any way they can to find inexpensive dirt to build their house on and make it affordable. A lot of our markets that we're familiar with, North Fulton, Cobb, Gwinnett, it is just so expensive to buy or develop or buy a lot, develop a lot and build on that. And that cost obviously is getting passed on to the consumer. And there's a huge need for affordable housing. And these are some of the counties that you can still build affordable housing. Mentioning the core market, this is a slide we used to present on quite a bit, and we've kind of tailored it back, but I want to bring it back again. I still think it's a great little segment. So our core markets, like we've mentioned, is in your navy blue. We actually do split up north and south in this instance. Our gold counties, we are second tier. It's Clayton, Coweta, Hall, Henry, Paulding, and South Fulton. Green is third tier, and fourth is your last tier. And this is just ranked on number of closings over the last 10 years. So, and most likely existing homes, I would guarantee that these are the most popular existing home counties as well. So looking at visually through market share, you can see the core markets market share really started taking a dive right before the Great Recession. That's because all the lots were getting gobbled up. Why did it peak? That's because all the builders bought the most desired lots, and all the lots were severely discounted. As those got eaten up, we see the market share dip down again. What's interesting is the third and fourth tiers. You can go back to that map. So Jackson, Barrow, Walton, Newton, heavy east side, heavy west side and south side, and north as well. Those, the combination of those have now become over a quarter of the market. We've never seen that before. And I'm just using those 26 county set that we use as Metro Atlanta, but you can look at Gordon County and Floyd County. You're seeing large builders move further and further out as well. Speaking of top builders, most of these are publicly traded national home builders. A couple of local guys, Rockland Homes, really standing out to us. They build a very affordable product, mostly townhomes as well. And then in terms of dollar volume, dominated by the publicly traded national home builders as well. If you're looking at the slide 15, 20 years ago, completely different. It would be nonstop local builders. But when the crash hit, who had all the money? It was these publicly traded. And they ended up buying a lot of the local builders' positions when everything was the way it was at the time. So residential lots, I'm not going to spend too much time on this. I kind of just want to go into basics of what's going on in the builders' minds in their business right now. So for the first time since 2011, we've actually seen new homes appreciate more than developed lots. And that's actually great for home builders. That if you talk to a home builder, a lot of them will say that their margins are much better than they used to be, because for a long time here, we saw lots appreciating much faster than new homes. And kind of how to explain this graph, but the diamond is going to be your year-over-year change for new home prices. The circle is the year-over-year change for lot prices. So anytime that circle is above that diamond, that usually means that builders' margins are shrinking. And a lot home percentage, if you are involved in new construction or ever want to be, a common number that a lot of them throw around is that 20% number. And that essentially means that if I want to build a $400,000 home, I really shouldn't be paying more than 20%. So in that case, it'd be $80,000 for the lot. And another thing too, even though lots, they're not appreciating as much as new homes, lots are still appreciating, 10, 20, 30% year over year. That's pretty substantial. And a lot of that has to do with the lot shortage that builders are experiencing. So it's kind of a complicated graph. So I'm gonna take my time on this one, but the blue bar is rollover VDL. We'll explain that in a second. Lots developed. That's just saying that this is how many lots were developed in that given year. And then the gold is the home start. So essentially a lot was purchased, a home was started. If I have my green bar plus my blue bar, subtract my gold bar. So that's my rollover VDL. That's my number of lots that I have on the market at the start of the year. And then I add the lots I've added throughout the year, but then I subtract the homes that were started. That gives me a rollover VDL number. And what you're going to see in this next graph, you can already see it right here, is that these gold bars are well above the green. That means we are building many more homes than we are developing lots. And when that happens, you have a lot shortage. And essentially the last 15, not really 15, maybe 12 years, we have seen year over year declines in rollover VDL. And that's, like I said, just essentially the number of lots that are developed that have not been built on yet at the start of a given year. And what we're seeing is VDL years of supply. You're probably accustomed to months of supply. The builders typically and land developers will look at it in a year supply number. And we are at 1.4 years at the start of this year. So that's not even accounting for the development that we've had and all the home starts. So at the start of this year, 1.4 years, that means that if we didn't develop any more homes in all of 22 or the first third of 2023, we would have absolutely zero lots remaining, which would be a crisis, obviously. And it's kind of a good thing. We are slowing down the starts a little bit, but lot supply isn't really going up either. So this will be an interesting number to see by the end of this year. Existing homes, something that may be a little more relatable to everybody. We had the same slide for new construction. As I mentioned, resales were even more insane. We saw resale price. This is 1 year ago. So 1 year ago, we saw prices over the last 12 months go up 20%. closings up 18%. Where are we today? Kind of what you probably expect. Prices are still rising pretty substantially, but closings are on the downward trend. I'm going to view this visually. This will probably make a lot more sense. So this is all time, not all time in our data. So it's going back to the late 90s. See our bubble forming, housing stimulus, and then let's zoom in on what's happened recently. This is right before COVID, and we actually had a big slowdown in 2018. Most of that was due to mortgage rates touching nearly 5%, which would probably be nice to see right now. But we saw a big increase. We saw the market really rebounding because rates were going down, builder confidence was going back up, lumber prices were coming down. And when COVID hit, we saw this big drop just for about 2 months, and then we skyrocketed. And I think a lot of people, who were a little nearsighted thought this would last forever. That was never going to happen. We've been saying that for maybe 18 months now. And you see the slowdown in our closings. We're still well above our all-time highs that we reached in 18 and 19. This is definitely kind of a little bubble that we had formed. A lot of it was, inflated by sub 3% mortgage rates as well. We're getting back to a normal level in resale closings annually. That will continue to drop. Our October numbers, you're going to see it dip down even more. We are going to be going back to this number, kind of similar to new construction, 18 and 19 closings here very soon. In terms of prices, though, they are still going up. They're still going up a good amount as well. I think last month we saw existing home prices up about 7 or 8%. I know y'all typically will look at FMLS. We do take FMLS in Georgia and combine it and then remove all duplicates. So I think it's a little bit better number. It's still very macro. But as you can see, leading up to last month, still substantial increases. This is kind of an interesting stat, something we've posted before, but I want to bring it back up. Is if you were to go back to 1997 and said that you did a 4% annual appreciation rate, this is green line right here. It's kind of hard to see because there's a lot on top of it. I probably need to move it up. But right before the crash, we were appreciating exactly 4%, which is pretty normal. You kind of want to see home prices go up 4% or 3 to 5% year over year. When we crashed, we were still substantially below that. We today have finally gone past that number. So prices will likely continue to increase at a decreasing rate, potentially see a flatlining here very soon. I've seen some experts say we're going to see 20, 30% drops in prices. Really don't think that's going to be the case, but I want to see us get back to kind of that 3% annual appreciation. I think that's a very normal number. It's a normal market, and it helps predictions for builders. Right now, it's just way too volatile. And why will prices not crash? A lot of that has to do with months of supply. Months of supply is still substantially low. And I'm sure a lot of people might be freaking out about the market right now. If you were to look at the last 12 months, this is a scary graph. This is going to be the number of active listings on FMLS at the start of every month. So it was actually kind of crazy. A couple of months we had under 8,000 listings. That was unsustainable. We knew that would never happen, and that's why you saw these crazy bidding wars at the beginning of this year, even last year as well. This green bar is going to be your year-over-year change, mostly increases now in inventory. So a year ago, we are up 80%. The number of listings at the start of this month as compared to a year ago. That would normally be a very scary sign. But let's zoom it out. How many active listings did we have before? Look at that. We're getting back still to that 18 and 19 number, where we had about 22,000 listings at a given time. That is normal. That will help our prices not skyrocket. And then when prices don't skyrocket, it will help buyers afford homes more. We'll talk about interest rates here in a second. That's probably the biggest concern, I would say, with the housing market right now. Now, looking at inventory, as inventory rises, months of supply is going to rise as well. Another, like I said, maybe scary graph, but do you really think that we could sustain under 1 month of supply? That's not sustainable. We're still at about 2 months of supply. Zooming it out, still very far off from 3, which we're accustomed to. And if you even zoom this out further, 3 months is still considered very, very undersupplied. You look at historically since 1998, here's your months of supply number. Even before the Great Recession, we were at 6, 7 months of supply. The 24-year average is 6.1. That's probably where you see a lot of people come up with that, 6 to 7 months being equilibrium. 6.5 being equilibrium. Anything under 6 is undersupplied. Over 7 is oversupplied. People, some builders will say that they think 3 is a number, or 4. I've had even somebody tell me 2. It's kind of whatever you think. I think 4 post Great Recession. I think 3 or 4 is a better equilibrium. 4 being the equilibrium. Anything under 4 being undersupplied. Us being at 2 means we are still very undersupplied. We're looking at it by price point. So overall, like I said, we're at just over 2 months of supply, but every price point, and especially the most affordable price points, we're under 2 months still. You really don't see, an oversupplied number until you get, I think it's like 1.5 million. It's kind of blew my mind, but 92% of listings are under 3 months. That means that we currently have, I believe it's 8% of listings are 1.5 million or higher on FMLS. That's pretty common in a lot of the major markets, like a Charlotte, a lot of the Florida markets. Actually, Florida's a little bit different, maybe like a Jacksonville. So I've talked about new construction. We've talked about existing homes. How do they correlate with one another? This is a very popular graph that we track for home builders. They want to see how their prices compare to the existing home market. So in this case, we have resales in green, the new construction annual price in gold. This blue line is going to be the relationship between the two. All we're doing is taking this green bar, dividing it by the gold bar price, and that's giving us percentage. So before the Great Recession, resales were on average about 90% of the average new home price. That made the new home construction very affordable for consumers. When resale prices crashed, we couldn't build homes cheap enough to compete. That's why you saw pretty much, we actually saw a 92% drop in permits in 2 years. The market really started rebounding in 13, and then here we are today. This line started shooting up in 20 and 21. That means that resale prices were appreciating much quicker than new home prices were, to the point where last year, the average new home price was the exact same as the average resale price. That's something you really never see in a market like Atlanta. You'll see that in like maybe a Charleston or a Savannah, some coastal Florida markets. We did have a little bit of a dip. As we talked about earlier, the new home construction has appreciated much faster than resales so far this year. That's just builders saying, hey, if resale prices are going up, we need to raise our prices too and get more money out of the selling these homes. And we had a lot of builders say, well, we're building smaller product. We even talked about how we're building more townhomes than ever before. So I said, all right, we'll look at price per square foot. So this is a resale price per square foot in dark blue. Kind of that aqua blue is new home price per square foot. Same thing, even price per square foot, nearly identical. There is not much of a difference between new construction and resale. And this is great for builders. As a person buying a home, why not buy new construction when the price per square foot is nearly the same, the average price is nearly the same. I will say the average lot size definitely is different than you buying a home from built in the 80s and 90s. Our lot sizes are getting a lot smaller because builders are trying to fit as many homes as possible on these tracts of lands they're buying. Comparing the two, like I said, kind of the same. And in terms of closings, this market, I said 25%, it's really more like 22%, but we're kind of in this new norm where the last 7 years or so, new construction makes up 20, 21, 22% of the market share. We used to be nearly 50%. 22% is still well above the national average. Today, nationally, about 10% of the market share is new construction. So we're more than double that, at least. And this is the relationship between the two. And the best way to talk about this is as this blue line goes up, that means resale prices are appreciating faster than new construction. What that usually leads to is more people buying new homes. And you see every dip, they kind of move hand in hand, except in 21. We should have shot up well above new construction market share. We did not, and that just goes back to our lot shortages. There is just not enough lots in Metro Atlanta to build on, especially with mortgage rates. We'll talk here in a second, but I think a lot of people are afraid to sell their home right now, and it's not adding to the inventory. What's the best way to add inventory? It's typically build homes. It's just it's not just lots. We'll talk about this in a second, but just getting materials on time, finding good workers as well. And that's your negative trends in the market. This is a survey done by the NAHB that comes out every year. And they survey builders and say, hey, what problems did you face in 21? What do you expect to face in 2022? And then probably by the end of this year, maybe it's early January, they'll do another one. What did you face in 22? What do you expect to face in 23? I have a good feeling inflation on the U.S. economy might go to number one. They're kind of hand in hand with building material prices. That's also inflation. Availability of time of building materials, just finding truck drivers to deliver lumber and appliances. It's a big struggle they're having. Availability of labor. Labor is still tough to find, good labor. You still have a lot of subcontractors of men in their 60s, and people, younger generations are not getting into these skilled labor positions. I have a friend who dropped out of college. He's a plumber, and he makes more than a lot of my college graduates. So there's definitely a big need for a lot of these positions. And then cost availability of lots, like we talked about. So we'll kind of briefly go through this, leave some time for some questions. But as I talked about cost availability of lots, just to recap, you can see the sharp decline in lots. This is actually a good trend, though, just seeing that home prices are appreciating faster because builders' margins were getting shrunk tremendously. 12 months change in CPI. I want to focus on this because we talk about inflation, but fuel, oil, gas services, gasoline, a lot of these electricity, a lot of these deeply impact builders. They're having to drive around a lot. And if it's expensive to drive around, it is expensive to build homes as well. And talking about CPI, it's highest it's been since 1981. Speaking of that, here's your lumber prices. This is right when COVID hit. We actually saw a big drop in lumber because there's an assumption that nobody wanted to build homes anytime soon because the market was about to just crash. Obviously, the opposite happened. 2 months later, we lived through the shortest housing recession ever, and housing market started to boom. And as you can see, in early 2018, we had a sharp rise in lumber prices. Mix that with the mortgage rates with sharp rise. That's why you saw a either flat or declined 2018 in a lot of cases. Zooming this out, though, this is during COVID. So here's our drop in COVID, and it turns into kind of like an AMC stock where it is just going all over the place. Luckily, it is kind of going back down to a little bit more of a normal range. I believe this is a week or two old now, but it's at least below our 2018 peak. I would love to see it get down to maybe more of this like $400 range. And I mentioned the truck drivers. We're about 80,000 short. This association thinks we'll be down 160,000 by just 8 years from now, 7 years from now. Mortgage rates. This is probably the biggest topic in the housing market, especially within agents as well, or if you're looking to buy a home. So 30-year fixed mortgage rate, big topic, right? Shooting up to 7%. I haven't seen today's numbers. I heard, we should be coming down here eventually. I don't think we can go forever. I know the Fed is saying that they're going to raise rates again. But I want to talk about the impact of this mortgage rate and why it needs to come down to help this market out. So our 10-year average is 3.9%. I want to say 4.5. That is what we really should be in. That's normal. Historically, it's very low as well. But I think 10-year, that's pretty recent memory. I don't think just because in the 80s they're 20%, you could say, oh, 7% is a great deal. I think 7% definitely is extremely high from what we're used to. I want to talk about something, and just to put in perspective of what's going on and why mortgage rates do impact consumers so substantially. And given, we're looking at a time in December of 2020 when mortgage rates were 2.7%. We're not going to see that ever again. Obviously, great time to refi or buy a house. Obviously, housing prices were skyrocketing at the time, but let's just say your average consumer bought a home back in December of 2020 at 2.7%. Average home price back then for new and resale was $345 grand. So that is going to be this kind of greenish line. Blue line's 30-year mortgage rate. This is going to be the purchasing power based on this given time frame. So let's just say that person who bought this home at a 2.7% rate for $345, if you account, just assume that they put 20% down, you don't account for insurance taxes or HOA, their monthly mortgage payment is $1,115. You can disregard that. I need to fix that. That's a typo. That should be $1,100 as well. So if I'm going to buy $1,115 home, or if I can only afford $1,100 a month, my mortgage payment, this green line will tell me what home price I can buy. So it peaked at 345, which when this person bought the home. But today, if I were to buy a home for $210,000 at a 7% mortgage rate, I would still have the same monthly mortgage payment as I would as that individual who bought that home in December 2020 for, obviously a $130,000 increase. The biggest caveat to mention here, though, is 20% down. Does that person have the cash to put 20% down? Because it's a lot easier to put 20% down on this home than it was back here. A big issue, though, is today's home price is $453,000. It is not $344, which is not even on the graph. So that shows you how much purchasing power has shrunk. And once rates started increasing, that's when we saw resale closings start declining as well. There's a little bit of a delay on here. This is a trailing 12-month average year-over-year change, but it kind of seems to be that once we hit kind of this, you can say it first went negative when we passed over 5%. I still think 4.5 is a good 4.5 is a good number to look at. That is when we did see a sharp decline down here. This was just natural decline. We couldn't see resale closings going up 20% forever. There's not enough people. And I would be worried that we'd be getting in 2006 bubble territory anyways. But we'll see. This line probably will directly reflect this one. You will likely see resale closings declining 15-20% these next few months in reaction to these mortgage rates. And I don't want to scare anybody, but I think it's good to have a heads up of what should be expected and what is really happening. But like I said, historically, hey, it's still a great time to buy a home because we're less than the 50-year average of 7 3/4. And today's, like I said, we're at about 7% today. After experiencing really 15-year all-time lows in mortgage rates, you could argue that 6% is the normal. That's where we should be at. But eventually one day 6-7% could be normal, and we'll just become accustomed to that. But I hope that doesn't happen, just because it would lose out a lot of affordability for a lot of Americans to buy a home. This is another survey. I'm not trying to scare everybody, but this is just kind of going off of what we're saying. This is national. So I think if you interview builders in Georgia, their confidence would be a little bit higher. But essentially, homebuilder confidence is another survey they do. How confident in the market today and 6 months from now? Took a sharp decline in COVID. We're taking another sharp decline. You can call this the mortgage rate decline, essentially. 12-year average, we're still substantially high. Near all-time highs. I think until mortgage rates kind of cool off, or at least we just get assurances from the Fed that they're going to stop raising these rates, I think builders are going to be worried, because if you keep raising rates, you're going to make buying a home very unaffordable. But what is saving this market right now, typically have more positive trends, but obviously this is a weird time, is this months of supply. This is keeping everything together. We're not up here. If we do get to up here, I think you can be a lot more worried. You can see post-crash, we had over a year of supply of homes at given points. There's just no demand. There is still some demand even with the rates. I think investors are, they're still buying up a lot of these homes with cash, so they don't have to deal with the mortgage rates. And that is helping some. We're still tracking iBuyers. Obviously, Zillow, they pulled out of the market. But iBuyers, they're still buying roughly 8% of all homes listed on the MLS today still. I think you will see them start, at least maintain, maybe even increase, because they're not buying homes with leverage like consumers have to. In terms of permits, going to reflect a lot on kind of new construction trends. Heated up way too much. We're slowing back down to reality, but we've actually had 14 straight months of year-over-year decline in housing permits, but we're still building more homes today than we were pre-COVID, kind of the given theme of a lot of these graphs that you've seen. And then historically, as you see, just like before, way off. Here's your 92% drop in permits, like I said, in just 2 years. And then us versus the nation's kind of experiencing the same thing. Very similar looking graphs. Pre-COVID bump, COVID drop, and then we skyrocketed, and now we're just kind of tapering down back to our pre-COVID levels. And if you want to compare us, the Metro Atlanta market versus the top 10 selling MSAs across the nation, they have something in common. They're all in the Southeast, Texas, or Arizona. If you want to count Florida as the Southeast, I know some people get offended by that, but we still say Florida Southeast. In our data, Atlanta is now number 4. It has been number 4 for the last 3 years. So year number 4, behind Houston, Dallas, number 1 and 2. Just so you know, Atlanta was the number 1 building market for a very long time throughout the 90s and early 2000s. And predictions, this year we are going to be down. We're saying, I think, 16, 17%. I think that's probably going to hold true. I think we're going to be down next year as well. Just based on predictions, mortgage rates are predicted to be 5.25 at the end of next year. That will definitely help alleviate some of these issues. Hey, at least it went down, almost 2%. That can help you afford a home a little bit more. I also think a lot of these consumers who are looking to buy homes, our equity in our house has gone up tremendously with these price increases. I think these mortgage rates really hurt the most as that first-time home buyer who doesn't have much equity to help buy one of these houses in the given climates. And with that, hopefully I didn't scare too many people. Like I said, there's still some positives to take out there. It looks very negative if you look at it in the last 12 to 18 months compared to today. But if you look at today compared to 2-3 years ago, before we had, you almost can call it a little mini bubble with the with post-COVID. I think people are going a little crazy. Now, I'm sure a lot of y'all experience it too, waiving appraisal contingencies, going 45K over list price. We're getting back to somewhat normal times once again.